The best investing strategies for beginners. In today's video, we're revealing the 5 best investing strategies for beginners. So stay tuned because you don't want to miss this. Welcome back to Money Mindset, the ultimate hub for finance content. If you're looking to become better at managing money and earning, then you're in the right place. But before we dive in, make sure to hit that like button, subscribe, and turn on notifications to never miss another finance update. Without further ado, let's jump into our list of the 5 best investment strategies for beginners. Number 5. Growth investing. Growth investing returned to the spotlight recently as the FANG revolution took hold of everyone's imagination and placed technology stocks and growth on every investor's radar. Growth investors look for shares that have already demonstrated much better than average growth across fundamental metrics, such as earning and revenue, and will continue to do so. Growth shares are typically overvalued, with above-average PE ratios, and could pay low or even no dividends. These are usually companies that are the front-runners in their respective industries, as we have seen in recent years with the explosion of tech companies. The growth investing strategy is not without risks, as unforeseen macroeconomic events could significantly cause growth stocks to decline. Number 4. Value investing. Value investing is extremely popular with long-term investors, and this strategy has produced some of the most consistent returns over the last century. Value investors look for companies trading below fair value or intrinsic value. Some characteristics are usually undervalued shares with low PE ratios and high dividend yields. If Berkshire Hathaway's annual shareholder meeting is fixed in your calendar, you have come to the right place. Chairman and CEO Warren Buffett are renowned for looking at companies with exceptional value and investing in them over the long run. When implementing this strategy, the investor would look at fundamental analysis to determine a share's intrinsic value. Using technical analysis, in addition, is a comprehensive add-on instead of just following the herd blindly. Number 3. Dividend investing. If you are thinking of ways to generate a passive income, this strategy might be right for you, as the main objective of the dividend strategy is to create an income stream for the investor. Dividend investing is not as attractive and thrilling as implementing a growth strategy, but is more aligned with value investing defensive nature. Companies with high dividend yields are very profitable organizations, but usually have lower growth rates in most instances, so think long-term. New investors looking to implement a high dividend yield strategy will look to companies with high cash flows, allowing large dividend payouts that could provide an immediate income. Looking to the longer term, high dividend yield investors should look to reinvest those dividends, as it could lead to substantial capital growth in a portfolio. Number 2. Buy and hold investing. The name says it all: buy and hold, and is most probably the most straightforward long-term investment strategy, and is inherently a passive investment strategy. The performance of the buy and hold portfolio will depend on the selected shares, but it has proven to be more effective than one might think. Investors are often their own worst enemies and react emotionally and sell their shares at the wrong time, which the buy and hold strategy removes from the equation. Investors looking to implement this strategy should first look for shares with solid global brands that have been around for a long time. These companies will likely not be disrupted over long periods and start small. If you get it wrong, it won't damage your overall portfolio, but if you get it right, it could lead to substantial long-term gains. Number 1. Factor investing. This investment strategy targets specific quantifiable characteristics or factors across asset classes. So in essence, it is an evidence-based approach to selecting assets like shares, with 2 main factors that drive returns: macroeconomic and style factors. Macroeconomic factors focus on the broader risks across asset classes, which look at economic growth, GDP, inflation, unemployment, a company's credit risk, share price volatility, and liquidity. The style factors, however, aim to explain returns and risks within asset classes and encompass value, momentum, market capitalization, and industry sector. Ultimately, the factor investing strategy should help diversify an investor's portfolio by improving portfolio outcomes, reducing volatility, and generating above-market returns. And that wraps up our list of the 5 best investing strategies for beginners. We hope you found these 5 tips helpful. Which of these tips was your favorite? Let us know in the comments below. If you enjoyed this video, don't forget to hit the like button. Thanks for watching, and we'll see you in the next finance adventure here on Money Mindset.